Archie, I'm still looking for ways to save on my taxes for this year. What can I do?
Well, Eric, let's harvest some answers. I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to Last Paycheck. I'm your host, certified financial planner Archie Hoxton. And this is part 2 of a 2-part series on year-end tax planning. And for this topic, we've got a special guest, Eric Lewis, certified public accountant, with us today. So thanks again for being here, Eric.
Yeah, thanks for having me.
Absolutely. So on episode 1, the first part of this, we covered required minimum distributions, qualified charitable donations, bunching itemized deductions, all these things that you can be thinking about at the year end when you're planning for your taxes. There's so much to talk about here that we figured a 2-part episode would be better. So diving into the next portion, I think the good place to start is tax loss harvesting.
Sure.
Why is this something that we should be thinking about at year end?
Well, you can't, you may have gains in your portfolio on other areas, or you may have, maybe you even sold a property and you have a gain. And you may also have securities or funds, something in your portfolio that's down, that's got a loss. A great way to wipe out some or all of the gain you may have on your other sales is to work with your financial advisor to identify these securities that have a loss that you can sell and then move into something nearly identical but not identical. Mm-hmm. So you're really in the same spot from a portfolio standpoint, but you lock in a loss that you've executed on that then offsets that gain. So from a tax standpoint, you can really cut your taxes by doing such a thing, but not change materially the portfolio as you have it.
Yeah. Yeah, absolutely. And we've talked about tax loss harvesting on previous episodes. If you want a deeper dive on that topic, you can go and look on that on the tax loss harvesting episode. But it's definitely something to be thinking about year end, because at the end of the year, right? I mean, one of the nice things about taxes is that you get a year and then you kind of reset, right? Mm-hmm. And so every year you reset. So end of the year, if you've got losses in a portfolio and you harvest those, well, those don't reset. Like, right. You get to carry those forward. Right. So even if you don't
have a gain, you're exactly right. That's a great point. Even if you don't have a gain, let's say you have no other gains, so you only get to use $3,000, which is kind of an archaic number that they never index for inflation. It's really kind of absurd, but it's only $3,000 that you can take on your 1040 as a capital loss.
Yeah.
But that carries forward. So if you do some loss harvesting and you have $40,000 worth of losses, you get to use $3,000 this year. And then next year, if you have gains, it'll offset it, knock it back down to zero and negative $3,000. So yeah, that's a great point.
Yeah. I mean, and in our practice, we've encountered, situations where someone, let's say they bought their house years and years and years ago, and part of their retirement strategy is downsizing and buying something else. Well, if you're married and it's a primary residence, you can exclude up to $500,000 worth of capital gains from taxes. So that's not, you don't pay tax on that part of the gain, but it's not unrealistic. If that was your first house and you stayed in your entire life, you could have more than that in a capital gain. And so if along the way you have been harvesting losses, maybe whether you needed to use them right away or not, you could then apply that to part of that gain that you would pay taxes on. I've seen that happen in real life and practice for real people. And it's like, well, good thing you were harvesting along the way. Mm-hmm. There are some pitfalls and things to watch out for, because a lot of times when we talk about year-end tax loss harvesting rather than kind of all the time automated loss harvesting, I've seen sometimes where someone may have let's say a mutual fund portfolio, and they go at the end of the year, I've got some losses, and they sell some shares of the mutual fund. What they didn't realize though is that that mutual fund was reinvesting capital gain distributions and dividends and interest along the way. And then they come to their tax preparer and And they say, oh, I harvested $3,000 in capital losses to offset my income. Well, part of that is disallowed because you purchased within 30 days, into that fund. And so that part is disallowed. And that's a common pitfall that many people don't realize. It's called the wash sale rule.
Yep.
And it looks forward and backward for 30 days.
Mm-hmm. The 1099 that you receive, the 1099B, is going to have a little code on it, a little code W, and that thing's going to tell us what we can't use. What part of that is a wash. Yep.
Yeah. Same goes for if you were to sell the fund and just buy it back within 30 days. That's why, like Eric, you said, you want to get something similar, not identical.
Not the same thing, right?
Yeah. If you own Exxon, sell it at a loss and buy it back 10 days later, that loss is unusable.
Right.
So those are common pitfalls. We go into much more depth on the other episode on tax loss harvesting, but that's something to think about, especially if you're doing it on your own manually. On the topic of capital gains, something else that you can do. So let's say you've got a portfolio with a ton of capital gains, and maybe it's a taxable account. Maybe you've got a purchase coming up in January. What's one way that you could control your taxes?
Well, it's always better to pay tax tomorrow rather than pay tax today. So if let's say you need to generate some cash, like you said, you've got gains. Let's say you need $50,000, and that's going to be 40. Let's say you did really well on this particular security. It's going to be $40,000 worth of gain. It's always better to defer some of that to the following year if you don't need the money in January. So you may want to split it so that you're doing some of it in 2023, some of it in 2024, as capital gains tax rates are graduated. So, you may want to consult with your preparer as you're executing this, so they can run a little projection for you and tell you how you can keep that, by doing a little bit this year and a little bit next year, you can keep that capital gains rate at the lowest possible number.
Right.
In some cases it might be zero, depending on what your situation is. So on the federal side. So so you want to coordinate with your tax preparer sometimes when you get into that to time the execution of that sale.
Yeah. And that's like what we were talking about with when you've got your tax year, it kind of resets every year. You get a clean slate at the beginning of the year. Use that to your advantage. Same would go for like an IRA distribution. So if you got the same problem, but instead of it being a large capital gain, you need to pull a bunch of money out of your IRA. Maybe think about pulling a little bit this year and a little bit next year. You've still got the same amount of money out that you need, but you're not going to run the risk of like bumping into a higher tax bracket.
You're kicking, if you do it all in 23 and you kick some incremental income up over into a higher bracket. Again, these tax brackets are incremental. It doesn't drag all your income up, but you want to minimize the amount that's taxed at the highest rate if you can. So if you kick that can to 24 early in January, then you're going to try and keep that below that bracket, the next bracket. Pay the lowest possible effective tax rate that you can is everyone's goal.
Yeah, definitely. Yeah, and again, with running with the theme of year end, the more you know about what the year has looked like, the better you can plan, and the more you can push into next year and have more control. Because we want awareness and control, and of course the most you can have is working with a professional,
sure,
right, who can run those kinds of projections.
Right. And we work, as you know, with a lot of your clients, and so one of the things we do about this time of year is we start getting realized gain reports from you. Proactively, because we work so closely together, and we get these realized gain reports and we take a look at them, we see where clients are, and then you start working with them on the loss harvesting. We start talking about what their tax situation is going to look like if they didn't do that, what their capital gains are, what their other income. So that communication, again, is key. Yeah,
absolutely. Kind of switching gears a little bit here for things to do if you've maybe procrastinated, contributing to retirement accounts. Right? Because you've got a limit every year. So for IRAs, it's $6,500. For 401ks, it's $23,000. Let's say you come to the end of the year and you've got a bunch of cash and you're not sure what to do with it. Well, if you haven't contributed anything to those accounts, you can
Sure.
go ahead and make a contribution before
Sure.
the end of the year.
And yeah, you can do that before the end of the year. Sometimes it's better to, that's one thing, sometimes it's better to not do it before the end of the year.
Yeah.
Because you may be close to a threshold that allows it or doesn't allow it, right? So
Right.
I get that all the time where someone says, oh, I contributed $7,000 to my IRA. And it turns out they weren't eligible to do so because they had something else happen that boosted their adjusted gross income up over that threshold. And then they've got to unwind it. Or I just literally had this week, some get their paperwork in advance of this deadline coming up. And they both made $7,000 Roth IRA contributions. And it just so happened that something happened that they tripped up over the max. So if you're going to be around those thresholds, again, communicate with your financial advisor, communicate with your CPA, start talking about that stuff, because we may tell you, you may want to put it to work right away, but if you're close to that threshold, we may want you to wait.
Yeah.
And then when you're talking about 401ks, you can't wait. You've got to do that one. If you're an employee and you haven't maxed out yet, you've got to get as much as possible in before the end of the year. Then you start getting into a math problem. If you're an employee, how much salary do I have left for the rest of the year? So can I hit that max?
Yeah.
So that's one you want to start thinking about early.
Right.
But from an IRA standpoint, or if you're self-employed, for self-employed folks, you can make like a SEP contribution, simplified employee pension. You can make that after year end. Right. Generally, you can't make a max contribution before year end unless you're 100% sure you've got enough income to justify it. So long story short, these things are complicated.
Yeah. Better not to procrastinate in the first place.
Yeah, exactly. Better to not procrastinate in the first place and therefore have these conversations so you can figure out what you can do. I just had one recently where a business owner started a 401k in 22, didn't tell us, right?
Yeah.
And then, year end passes, they procrastinate, we're working on their tax return, and they say, how much can I contribute to my plan? And they didn't do anything in 22. And so they're kind of out of luck now, you know? So communication is key on all of those things.
Absolutely. Because those rules are complex, and each different kind of account or plan, they have little nuances that are slightly different from one another. It's like you were saying, there are different kinds of limitations.
Right.
Roth IRAs, you make too much money, you can't contribute.
Right.
Which actually is, and leads to another point here, something to think about, would be like Roth conversions. Mm-hmm. So in other words, converting part or all of a traditional IRA to a Roth IRA. It's a big taxable event, particularly depending on the size of the traditional IRA or how much you convert for a partial conversion. That's something where having a pretty good sense of how much you're going to pay next year, how much taxable income you have this year, is useful in making that decision. So that's another thing.
Yeah, a lot of other things might come into it. Let's say you're a small business owner and you had some circumstances that generated a pretty substantial loss in your business, and you've got basis to deduct that loss. Well, that might be a good time to convert Roth, right? Because you're offsetting it. You're not going to be paying a lot of tax on that Roth conversion today because of those circumstances. So there's a lot of different things that can come into play about whether you'd want to do that, when you want to do it, what your age is, what your horizon is, all those different things. Again, comes back to communication. Have these discussions.
Yeah, because they're particularly if you're a small business owner. I mean, that there's so much complexity there. That you got to be communicating and just going ahead and doing something without, being aware or having a close relationship with someone who knows of all the potholes.
Sure.
You may end up in a pothole, and it might be one that is costly to get out of.
And no offense to all of my wonderful attorney friends, when my clients ask me, I tell them I don't bill like an attorney, right? If you've got a question and it takes me 5 minutes to answer, I'm not going to send you a bill, because I would much rather answer that question in August than and we make the right decision from a tax standpoint. Then you come to me in March and say I did X, Y, or Z. But if you would have done A, B, or C, we would have been in a different scenario. But they were afraid to email me because they thought they were going to get a bill. So that's kind of how I operate. Lots of CPAs do the same thing.
Right.
We would rather, our clients have those answers real time when they're making that decision.
Yeah. Because the more proactive you are, the more opportunities you'll have to avoid those potholes, save money, and keep more money in your pocket, right? Because that's the name of the game when it comes to the tax situation. All right. Well, that kind of wraps up our 2-part series here on year-end tax planning. We hope this was really valuable to you. We hope that you plan way ahead for your taxes, and communicate with your tax preparer and your financial advisor for ways to save money. So that's all. So remember to like and subscribe, turn on notifications, share with your family and friends, and we look forward to seeing you next time. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.